Hello students, this is Professor Vincent Osaya. Welcome to my class. This is part 5 presentation of chapter 16. Chapter 16, Dilutive Securities and Earnings per Share. This is where we left off. We're talking about how to calculate weighted average shares outstanding. And we also talk about the justification for doing so. Now, let us take a look at the additional illustration. We did one illustration in part 4 of the presentation. Here we said B company has the following changes in its common stock during the year. The same example that we went through in part 4, except for, look at this, June 1st, 60,000 additional shares were issued because of 50% stock dividend. So at this point in time, 50% stock dividend of 120,000 is 60,000. So the company now have 180,000 shares. On November 1st, they issued 30,000 shares for cash. So at the end of the year, they had 210,000 shares. So we are now to compute the weighted average number of shares outstanding for the company. So let's take a look at what happened here. January 1st through March, we went through that. Shares outstanding was 100,000. But now, take a look at this. Remember the rule that we talked about? We said that if a company declares and paid a stock dividend during the year or had a stock split during the year, we assume that it happened at the beginning of the year. So we have to restate the number of shares. We have to restate the number of shares at that point in time. So now let's take a look at what happened here. So we go ahead and restate the number of shares from January 1st to March 4th, which is 100,000. Multiply that by 1.5, that is the 50%, and multiply that by 12, that will give us 25,000. Now, the number of shares outstanding from March 1st through June 1st also have to be restated. 120 multiplied by 1.5 multiplied by 312, that will give you 45,000. I don't have to explain the rest. The rest is self-explanatory. So the weighted number of shares outstanding at the end of the year is now 180,000. So we have taken into consideration how to restate previous shares if we have a stock dividend or stock split during the year. So moving along, let's take a look at the last objective. How do we compute EPS per share in a complex capital structure? Now, to compute EPS in a complex capital structure, we first of all have to compute a simple EPS. So we already talked about the complex capital structure exists when a company has convertible security, options, warrants, or other convertible securities. Now, let's take a look at the example we have here. Diluted EPS includes the effect of all potential dilutive common shares that we are outstanding during the year. So what are we talking about here? So we are trying to determine the impact those convertible securities will have on EPS if they were actually converted. So here's the big formula. EPS, how do we compute EPS? For basic EPS, basic EPS is applicable to a company with simple capital structure. So the formula, as previously discussed, is net income minus preferred dividends. There's a typo here. This is not preference. This is preferred dividend, meaning preferred stock dividend. Then divide by weighted average shares outstanding minus impact of convertibles minus impact of option, warrants, and other dilutive securities. That will now give you diluted EPS. So companies will not report diluted EPS if the securities in their capital structure are anti-dilutive. That's another fancy word that we are going to talk about in a minute. So moving along, let's take a look at diluted EPS. Here we are zeroing in on convertible securities. So here, the assumption here is, let's read this. We are going to measure the dilutive effects of potential conversion on EPS using the if converted method. I want you to know how they came up with this method, or the name of the method. They said if converted. Well, the assumption here is, you need to catch this, that if the securities are converted, how would EPS be impacted? How would EPS be diluted? And that is why they call it if converted method. The securities are not converted, it's just an assumption. If they are converted, what will be the impact? So this method for a convertible bond assumes the conversion at the beginning of the period. So the assumption is it happens at the beginning of the period or at the time of issuance of the security, if issued during the period. So that is a rule that you need to know. Assumption, beginning of the period. However, if it is issued within the during the year, then we have to take that into consideration. And number two, the elimination of related interest net of tax. What does that mean? Remember, when we have a bond, we have to pay interest, and the interest is an expense. So the interest expense was taken into consideration in calculating the net income. If we are making the assumption that it's an assumption that those convertible bonds were converted, then we need to add the interest expense to the net income. Because if we are making that assumption, that means the assumption is they are no longer there. They are no longer actually a debt for the purpose of computing EPS. So we have to add back the interest expense, net the related tax. So here is an example to illustrate most of the rules that we have talked about thus far. M Corporation has net income of $210,000 for the year and a weighted average number of shares outstanding during the period of 100,000 shares. The company has two convertible debenture bond issues outstanding. Two. One is a 6% issue sold at $100, at 100, that is at par. Total is $1 million in a prior year and convertible into 20,000 common shares. Interest expense on the 6% convertibles is $60,000. The other is a 10% issue sold at 100, again at par. Total $1 million on April 1st of the current year and convertible into 32,000 common shares. Interest expense on the 10% convertible bond is $45,000. The tax rate is 40%. So let's take a look at how all these pieces fit together. I guarantee you, you are going to love this. So first of all, we have to calculate the basic EPS, and the basic EPS is net income divided by the weighted average shares. So the net income clearly is 210, weighted average shares that was given to us 100. So the EPS, or the basic EPS, is $2.10. Now, we need to calculate the weighted average number of shares outstanding as follows because of the debenture. So now the assumption is these convertible securities are converted. That is the assumption. So let's take a look at the impact that will have on the weighted average number of shares. So the weighted average number of shares is 100,000. However, we need to shares assumed to be issued. So we are saying that 6%, the 6% debenture happened the year before. So we assume that they were in existence at the beginning of the year. So they were to be converted into 20,000 shares. So the assumption is, yes, it was done. It's an assumption. Then the 10% debenture, as far as date of issue is concerned, was during the year. So April 1st, so we have only 9 months. So 912 or 32,000, again, we are assuming that the 32,000, the debentures were converted to 32,000 common shares. So 912 of that will give you 24,000. So add that, and that will give you 144,000. So the weighted average number of shares adjusted for diluted securities is 144,000. So now we are trying to compute EPS in a complex capital structure. Why is it complex? Because we have dilutive securities. convertible securities that have the potential to dilute the EPS. So let's calculate the EPS here. So the basic EPS, we already done that. 210 divided by 100, that will give you $2.10. Now the 6% debenture, so that is 60,000. Remember, that is the interest expense. So the interest expense now have to be added to the net income. Remember, the net income is the numerator, net of tax. So the tax rate is 40%. So 40% of 60,000 minus 60,000, or we can just say 60,000 multiplied by 1 minus 0.4, because the tax rate is 40%, and that will give us, we are now adding back the interest expense net tax. Now, if the assumption is the debentures or the bond were converted to common stock, then the numerator now needs to be increased, because remember now that we said that they could be converted to 20,000 common shares. Now let's take a look at the other debentures. Another debenture, 100,000. Again, the interest expense has to be added to the net income, net tax. Here 912, because it was in existence only for 9 months. Now again, $24,000 as previously computed. Now we now have the effect on this debenture on EPS is 1.879. But don't let the bottom line confuse you. The most important thing is when you do the math and the numerator divided by the denominator, you will now come up with 2.02. So that is the diluted EPS. So obviously, look at this. The basic EPS is $2.10. The diluted EPS is $2.02. So what are we talking about here? What you are saying here is, for a potential investor, you know that the EPS of this company is $2.10. You also know that there are some securities that could be converted to common stock. If those securities are converted, what will EPS be? EPS will not be $2.02. So the EPS is not as impressive as the basic EPS. So we just want the potential investor to be aware of the potential impact of the dilutive securities in existence for these clients. Now, here are other factors that you need to pay attention to. Number one, the conversion rate on a dilutive security may change during the period in which the securities are standing. In this kind of situation, what we do is the company will use the most dilutive conversion rate available. Another important rule that may be more important that you need to know is, for convertible preferred stock, the company does not subtract the preferred dividends from net income in computing the numerator. Why? The company does not subtract the preferred dividends. Remember, on the numerator we said net income minus preferred dividends. Why? Because if the assumption is that the preferred stock is converted to common stock, then there is no basis for subtracting preferred dividends from net income on the numerator. That is basically here is the answer for you here, because for purpose of computing EPS, it assumes conversion of the convertible preferred to outstanding common shares. Now, let's take a look at the additional illustration of complex EPS computation in a complex capital structure. I don't think we are going to be able to wrap up this presentation in this part of the presentation. So I think this will be a good cutting, a good point to cut off for this presentation. So we take it from the next.